Hi, welcome to today's webinar. We will be starting a new topic on the 1031 exchanges and how the tax reform impacted a few of leading industries in today's economy, the real estate investors and the cryptocurrency traders. Before we dive into the changes, I wanted to go over a quick summary of what a 1031 exchange is not, and will never be. A 1031 exchange is a transaction in which participating parties can defer all or a portion of the tax associated with the transaction to a later date and time, usually to when the property is sold or otherwise disposed of. A 1031 exchange is not a tax-free exchange. It is a tax deferral. And a 1031 exchange will never be a type of transaction that could be implemented without the participation of your tax accountant in the discussion before, during, and at a later date of sale or disposal. So for that reason, I will not go into all the details on how to structure the transaction to qualify for the 1031 treatment. Every transaction is uniquely different, and all circumstances surrounding it are important to the outcome. So do talk to a professional before considering or entering into a 1031 exchange. On that note, let's dive in first to discuss the changes the tax reform brought to the real estate industry. The biggest change in Section 1031 is the complete repeal of personal property exchanges. The section now exclusively refers to real estate exchanges and has been retitled Exchange of Real Property Held for Productive Use or Investment. Real estate exchanges are subject to the same rules and regulations as under the previous law. All real estate within the United States remains to be like-kind to other domestic real estate. Foreign real estate continues to be not like-kind to real estate within the United States. Personal property assets can no longer be exchanged. You can see a list of examples in the attached article in a description to the video. Although tax can no longer be deferred through a 1031 like-kind exchange for these assets, they also knew with the tax reform, 100% bonus depreciation can be used to offset any capital gains or depreciation recapture. That will be it for the effect on the real estate investors. Now let's change gears to cryptocurrency. Generally, cryptocurrency tax treatments remains unchanged from the previous law. Cryptocurrency traders must report income, both domestic and foreign, on all capital gains on all currency, and may also have a requirement to file an FBAR in the case that they are trading on platforms outside the United States. As for the effect of the tax reform on the 1031 exchange and cryptocurrency trading, like I have mentioned earlier, the tax reform eliminated Section 1031 treatment to all properties except for real estate. Cryptocurrency is not real estate and therefore it does not qualify for 1031 treatment. This means in the case that one coin is traded for another, or if cryptocurrency is used to pay for other services or merchandise without selling it for cash, it will trigger a taxable event. And for tax purposes, it will be treated as if the coin was first sold, resulting in a gain or loss, and later used the proceeds to pay for the new coin or other merchandise. Just so we don't end on a sad note, the ability to hold cryptocurrency long-term to benefit from lower capital gain rates was unchanged with the tax reform. Like many already said before me, there are winners and there are those who didn't win when it comes to the tax reform. In the upcoming webinars, we will take a look at a few in both categories. So stay tuned. That is it for today. Until next time.